lot of business with Echelon from the contract surety side, and so her father and her brother and now her have all worked at the brokerage. Some of which have transitioned to Echelon, others who have just her dad just recently retired. So yeah, so you're in a pretty good surety room, but developer surety is definitely a different animal, and so anyways, yeah, if you could clear that up.
I don't know why it's not doing that. I'm gonna have to open this. Is it okay if I download it?
I just don't know if they'll let you.
Oh.
Is your life recording?
Yes.
Like a family of cops?
Yeah. Just trying to live in their footsteps.
Just an extension.
It may.
None of us
You
thought
can
we would
try.
do this,
I
but
just-
we all are.
Cool. So insurance works.
Yeah.
Usually, anytime I try to do anything,
I
it
thought I
asks
loved
me
it.
for passwords. And everything.
Yeah. Oh, it's just an
Teaching to
extension.
bring
Okay,
that-
there you
Okay.
go.
So it's okay.
Yeah.
Never
Well,
persevered.
he was very hesitant though. Initially, he was
Yeah.
very hesitant.
Yeah.
He wasn't just jumping in.
Yeah.
Should have seen him when I asked him to take it. Does he have a nose ring or ear ring? I forget.
No, it's fine.
So you should have seen his face when I asked him to take it. Her brother has a nose ring. He used to work here, and he was working with Darren. We were doing a big broker meeting at UG game. So I kind of took my side. I said, Peter, I said, do you mind?
Yeah.
He was actually really good at it. He's like, yeah, no problem. I totally get it.
That's funny. So just before we start, I can give you guys just sort of a brief background on me, because I, although working for the insurance company in a surety space, have zero experience with contractor commercial surety. I know developer surety, and the reason for that is I actually came from Terrion. So the experience I have is I was 8 years at Terrion in the licensing and underwriting department as an underwriting analyst there. So if you've had any experience with either Dill or Brian Hamma, that's sort of who I worked with in that team. So I know developers, I really know Terrion. And so I did a very brief stint at Travelers. I did about 10 months there out of Terrion, and then was offered the opportunity with Steve to help sort of start the developer surety and book at Sovereign. So it's been an incredible couple of years. It's been very busy, but it was completely the right decision. It's a great company, and both Steve and I really, really like what we do. So that makes it a lot easier to do it every day. So if there's any, unfortunately, I mean, you guys wouldn't have questions about the other surety angle, but and maybe one day I'll be coming to you guys for that. So it's a fairly brief presentation. It's about 25 minutes. I'll just take you through sort of who Sovereign is, and then the bulk of it really is developer surety. And at the end, just a few slides about where you guys as brokers fit into that. And I mean, if you have any really, really pressing questions that you can't wait, I'm happy to answer them. But otherwise, we can just kind of do the questions and all that at the end if you guys are okay with that.
Very patient, so
Yeah, I mean, the good thing is the question probably gets answered further down the line, but really, it's fairly informal. So, in terms of residential surety, some people it's residential or developer. It just depends on. Developer is typically in Ontario. Residential is across the country. Right now, we are the newest provider of residential surety in Ontario, but as people become aware of what a profitable business it is and just how much condo construction is out there, there are new entrants right now. They're sort of in the back end and in terms of a reinsurance role, something like that. But we wouldn't be surprised to sort of see people start coming out to the forefront in terms of other insurance companies in other markets. We provide Terrion bonds as well as deposit protection insurance, which is we've sort of branded DPI, which encompasses ECDI, CCDI, EHDI. So it's both the residential and the commercial. What we do at Sovereign is right now we're targeting those mid-market developers between 50 to 250 units and combined facility sizes between $1 million and 25 per project. For me, our key client right now is either the person that's been building freehold and they've been building horizontally and now want to make that change to go up, or people that are have started doing sort of townhouse condos and are moving. So what our hope is, since we're relatively new to the space in terms of sovereign, what we want to do is we want to be able to build with our clients. Right now we have a max per tower or per common element number of 25 million per project, but an aggregate of 100 million per client. So as that increases, we're hoping so does our clients' capacity.
So I know I'm supposed to wait till the end.
No.
But okay, so I guess the area where I love this slide because it tells me you're looking at a $125 million combined facility. So that gives me your target, which I love. And I love that you said that you want units between 50 to 250 because that gives me a good understanding. So it might be, for example, 50 units at 200,000 each would give me, what's that, 10 million bucks?
Mm-hmm. Largely, it depends on where you're building, to be perfectly honest. Like a 250 unit condo in Toronto may be well above a $25 million facility, whereas you may be able to do a 300 unit project if you're building it out in London. And that is, so if it's a 2-tower project, we consider each tower a project. So we would have the ability to do $50 million. Like I think the one that you and I talked about was a couple of towers. So as long as though they are phased condominiums, then we have the ability to do each one of those towers up to 25 million a piece. And we do have the ability to do special acceptance, but there needs to obviously be a good reason for that.
So to get my question then, because we get a lot of calls for the Tarion approval, and a lot of it, as you said, is on the residential side.
The freehold side.
The freehold side.
Right.
So that is a no.
Currently, that is a no. The reason for that is it's not the same bond. So your bond, so you have a $2 million bond, and so you're building a 100-unit condo, you have a $2 million security requirement. That bond is attached to that common element number. So that security is linked to that tower. When you look at a freehold space, and Tarion would ask what's called a blanket bond. If it was the same $2 million bond, that bond can be applied to any unit or project within their entire registration. And that makes it a much riskier product for us. And if the wording of the bond itself is what actually, because it doesn't allow the surety to control their exposure, it allows Tarion to control the exposure. So the following year, when the builder does the renewal of registration and they say, I want to build 100 more units, Tarion can say, well, we already have this $2 million bond, so we'll just add it in under that as well. So they also have the ability to add different registrations if there are common affiliates to those registrations. So in that respect, it takes all of the power to control the exposure away from the surety. And that's...
So they can increase your exposure, obviously.
They can't increase it because we have to provide a rider for that. So they can ask for an increase, but we don't actually have to. That's the one aspect of control that we have. But we can't control how our risk is spread, and we can't control over how many units it's spread. So if a builder was doing 100 units and then said, oh, it's actually going to be 130, they could just kind of slide that in underneath as the bonds fall off, or sorry, as the warranty falls off. So we can't, and we also can't control when we get that bond back. So that $2 million bond could be used as security, and as the 2-year builder warranty falls off and the builder's adding more in, that bond could be out there for 15 years. So currently we're not doing that. I know I know us and other sureties are talking with Tarion about sort of amending the wording and giving the sureties a little bit more control, but as the regulator, they don't have to. They really don't need to do that.
So let's take a crude example. So you've got a 100-unit project, say it's in a wetland, okay? So now we're talking about, let's just keep it really simple for math. So you've got a $100,000 unit cost, which I know is low. So that gives me a $10 million project. How do you then determine how much security would be needed? Or how big the bond size would be needed?
The bond size is determined, if we're talking about condominium,
Yeah.
it's $20,000 a door. So it's,
So the 100 times 20K is going to be the bond requirement,
yes.
which is what, $2 million?
Yeah.
Times 20. That's what you wanted, the $2 million.
Yeah.
Subconsciously.
Yeah, so when we're talking about the $1 million to $25 million, that's just for our facility. So that obviously is when you're looking at $25 million just in deposits, that's obviously a much, much larger project cost than that.
Right, I'm just using,
Yeah.
numbers, kind of think about it. So it's
Yep.
possible.
Yeah.
So of the $2 million bond requirement, the two bonds, we're talking about the Terrion bond and we're talking about the DPI. I'm sorry if I'm blowing up your presentation.
No worries.
I apologize.
You're the only thing in my calendar today.
So which bond applies to that $2 million? Like what are the scenarios? How does that work?
So the way that it works is if you're looking at a $2 million bond requirement, that is simply the bond requirement. That's
Terrion bond requirement.
yes.
And that's for Terrion, just to say to Mr. Builder, you are approved that you can fly the Terrion flag. And
Yes.
if there's
And you can open for
buildings,
sales.
And you can open for sales. And this is only in Ontario, correct?
Yep.
And it's so if they have warranty claims, it's sort of like a way for the consumer to have some confidence that the warranty claims are going to get looked after.
Yep, that's right.
Okay. And then the DPI, that's
the insurance portion of it.
right.
So that would be if you're looking at $100,000 for this example, for the $100,000 product, it doesn't. The numbers get a little confusing, but if you're looking at taking a $60,000 deposit total per unit, the first $20,000 of that is covered by Terrion. The remaining $40,000 is what's going to be covered under DPI. Once the unit closes, you no longer need DPI, so that goes away, and what you're left with is what now is the same bond physically, but is now deemed a warranty bond. And what that does is it allows sort of it's Terrion's stick, to be honest. They would never demand on the bond and use that bond to pay for warranty claims while a builder remains registered. So they don't pay it out and give it back. What happens is Terrion will pay out the claim and then invoice the builder for that claim. It's not an automatic thing where the bond gets called and then we sort of deal with it. Like having a claim on a surety bond, on a developer surety bond or Terrion bond is a big deal. I mean, knock on wood, we don't want to see them. We haven't seen one yet. And I mean, in my 3+, like, not that it's a super long career that I've been on the industry side, but even on the Terrion side, I think, 8+ years. And I think we called on 2 bonds. And that's because a builder is now no longer registered. So that is, if they want to continue building, that is their livelihood. So it's a good way just to ensure that they do honor their warranty obligations.
So is DPI insurance, is it required if you're going to take over that 20K? Is it like mandated?
It's required if you want to use the deposits in your if you want to include it in your capital stack, because if you don't have DPI, those funds would never be released by the escrow agent. So they would be protected. They're either protected 100% by never leaving the DTA, or they're protected 100% through deposit protection insurance.
It's rolling too, right? So if you were to do a DPI withdrawal on 50 units, let's say, in order to get the funding, once those 50 units close, that portion of the bond is actually closed off. It's like a quarterly charge as well.
Yes, but the facility doesn't get closed until all of the units have closed. Like, it doesn't mean that you can then use that money for something else. It just ends. but it doesn't end like per home. Like typically when you close a condo, you're not closing them one at a time. You're going to do a bulk closing of about 90%. And typically at 90%, a surety will say, okay, you're done, and we'll close that. So if there's still deposits remaining in there, if it can be a warranty retention amount as part of the terms and conditions of registration that remain in there, and then they would have access to pull out funds over and above that warranty retention amount and that's all in the escrow's hands, because that's all in the solicitor's hands, because they're going to be using the proceeds to pay off the construction lender, pay off any equity lenders that are involved, and then finally pulling out the profit of the project. A lot of that is in here. No worries. We'll kind of rush through the sovereign part and really focus on the.
We did a conference call, so I got a little bit of the information.
Yeah. So my problem is I've had it in drips and drabs, but never enough to
Yeah.
edit, so this is great.
And you guys are recording this, but I can also send this presentation to you if there's any questions you guys have. I mean, I'm always available. So in terms of just a quick slide of who Sovereign is. So Sovereign is actually a subsidiary of the Cooperators Group. So while we are sort of a smaller company, we focus on commercial. We don't do personal lines, but we are a member of a much larger cooperative. We've got about 70 employees in our Toronto office down at One York. Our head office is actually in Calgary, and then we have sort of people in Vancouver, in Halifax, a few in Quebec. So in terms of, I mean, I said in my introduction, I think it's a great company. It's a socially responsible company. They look out for, sustainability. We moved into One York a few months before I started, but it's the new Menkes building at One York. It's sort of a LEED Platinum building, and they sort of want to walk the walk. And sorry, there's just.
We deal with Canberra and Gavin.
Oh, okay. Yeah, Canberra sits right behind me. Yeah, so I think in terms of the surety department, it's Gavin, Tanvir, and Tanya in Toronto, and Dave. But there is a larger contingent out in Calgary. So I think that's sort of where all the underwriting assistants are. Connie, I can't remember her last name right now, but they're spread out across the country. In terms of the key value propositions, and we sort of live this in developer surety, is we are a solution-oriented staff. So it's not that we have this box, and if it's not 250 units, if it's not this, if they don't have, every single thing, the best of the best, we're just going to say, no, thank you. We try really hard, and part of this is just the result that we're new. We want to build a client base. We want to build relationships that we will absolutely do our best to work with you guys and work with the clients to try and find a solution and help them get their buildings built. We have a risk-based underwriting philosophy. As I said, we try to deliver customized solutions to the market. And one of the things that I think we do better than some of the other sureties is honestly just we're faster. Part of that comes from our underwriting philosophy, which we talk about later, is that we split up our underwrite between a client and a project. So you're not starting net new every time a new project comes in and you're re-underwriting a client. So once that initial underwrite's done, you're sort of able to kind of plug that next project in much faster, and then you have a better understanding of what the client does. In terms of just what Sovereign does, as I said, we don't do personal lines. We specialize in commercial lines with sort of not necessarily a high risk, but more complex risk. So we do fleet, energy, loss control, metallics, oil, gas, umbrella, and excess. And then in terms of the specialty line, which is where we fall under, we do the professional liability, tech and cyber, which I know is a growing book in industry for us, equipment breakdown, surety, and so Steve and I fall in the developer surety kind of falls in under the surety heading.
A warranty or special programs are there?
There are, yeah. We do have an MGA, a small MGA. I don't know if it's small actually, to be honest. I know it's 2 people, but
Yeah.
So yes, we do
Who's that?
the programs.
The warranty.
Bill DeFair and Jennifer Jacoby are the people that I know do that.
But it's under an MGA, or is it?
I'm not sure,
You're not
to be
sure.
honest, sorry.
Phil
And Jennifer. So I believe Phil is based out west, but Jennifer Jacoby is here. So why we're here today is Developer Surety. This is sort of the kind of Webster's dictionary, which we will definitely spend the next few minutes unpacking. It's the provision of warranty protection bonds, or Tarion bonds, and deposit protection insurance that serve to protect individual purchasers' deposits during the construction of their home, and then switch to preserve the warranty protection rights once owners have taken possession of those homes. Once developer surety solutions are in place for a builder or vendor, Sovereign also allows the release of deposit monies from the trust account to actually fund physical construction, which is why it's such a great product. In terms of how developer surety fits the need in the market, there's sort of two ways. It's that the legislature and Tarion require it, but the service that it provides to builders is why, so it's the want and the need. So the Ontario legislature, the condominium purchaser deposits are protected until their homes can be delivered, and that's just the Condominium Act. And that the new construction, condo construction, is up to the building standards of the Ontario Building Code. For Tarion, it must ensure that purchaser deposits are protected, and they demand that additional security in case a developer isn't able to meet their warranty obligations. So as I said, on sort of the very far end of that spectrum, the bond gets called, and the bond is used to either pay purchasers back their deposits, or if it's after that, make the repairs and honor the warranty obligations for the builder. In terms of why a developer would want that project is that they either need it to register their security with Tarion, and they want access to affordable capital during the course of construction. So when it comes sort of down to that bottom line, it's real dollars and cents back in their pockets, because you're looking at, a one to 1.25% per dollar versus a construction loan at 7%. So you're actually, that delta of 6% is actually going straight to the bottom line.
So, that's the rate, so if we're going to 1.25,
I'm sorry?
that's the rate?
It can be anywhere from 75 points to 1.5. Yeah, so 75 points to 1.5. And then there's commitment fees, there's early release fees that are different, and those are ones that we've seen kind of run the gambit anywhere from 0.5% to 3%. So, so in terms of the product mix, Tarion bonds, and for the surety people, you guys all understand all of this part of it. So the actual Tarion bond is the agreement between Tarion, the developer, and the surety. It provides the deposit loss protection. It provides that limited warranty for incomplete or deficient work. It provides delayed closing cost coverage and acts as the prescribed security for Tarion deposit releases. So you'll hear about the deposit, like physical deposit forms that need to be signed, and that acts as prescribed security for the escrow agent to release the Tarion funds. The other side of that is that deposit protection insurance. There is no warranty component to that. We discussed that once you do your bulk closing, once you're at 90%, then that facility closes. That facility goes away. It acts as the prescribed security for the release of the deposit monies from the trust account, and provides deposit protection comfort so that the purchaser is always going to be 100% protected, whether it's through DPI or whether it's just simply being retained within the deposit trust account if they don't want to get that DTA.
And the cost, went back to the cost, that was about a point for both type of bonds.
Yes.
So it would be 2% plus one.
Yeah, exactly. And it's charged differently. A Tarion bond is charged ahead on an annual basis, and the DPI is charged as you use it. And I mean, that will vary between different surety providers. Some people will charge as soon as you release the funds, they'll charge for the remainder of the renewal period. At Sovereign, we do it on an as-used basis, so we do it quarterly. So it's quarterly, sort of after the fact. So Tarion, you're paying ahead. DPI, you're paying after.
That's what you're talking about. Right.
Yeah.
Question, is there a set expiry date, or is it the life of the project when they actually sell it?
There is a renewal date, but as part of the term condition, it is an automatic renewal. So it's a year from the date that the Tarion bond is released. So from once all the security has been registered. So it's not like as soon as you apply and we give it a bond number, we start charging. We don't start charging until the day that the solicitor releases that bond to Tarion. That then becomes the renewal date. And so what we look at is, for the first couple of years, it'll be an annual renewal. Once you're looking at a point where there could be possibly a security reduction from Tarion, we may shorten that renewal period to 6 months, 3 months, whatever it may be. So I did just a quick example of what a typical residential surety facility looks like. So our example project, we have 150 unit count, an average deposit of 20%, which is typically what you'll see in the GTA. If you get outside of the GTA, 15 to 20% is still normal, and we've seen a couple further out in the west that are taking 10%. Unit value of $600,000, so you're looking at a total deposit per unit of $120,000. So how we come up with the facility calculation in terms of, so you've got your first $20,000 that's going to be covered under that Tarion bond. The remaining $100,000 is what's going to be covered under a DPI facility. So you're looking at, and that gives you the total $120,000 deposit per unit. So once you multiply all of that by the number of units, you've got so you'll be sending a $3 million bond to Tarion, and you'll have a $15 million DPI facility. So you're looking at a total facility size of $18 million for this project.
That's what you meant by combined facility.
Yes.
All right.
So your total aggregate facility is so that $18 million is the maximum facility that you'll see. And obviously this is as you collect it. It doesn't mean it's not a loan. If you never collect $18 million, you can only use to the maximum of what's actually in the escrow, or what the escrow is holding in the GTA.
It's very helpful.
The other thing you'll see once we start actually building facilities, we do require the source and use of funds. So what you'll typically see from us is you'll see a facility that sometimes is much larger than what is actually contained within the source and use of funds. And that's simply because there is a cap on when developer's making the capital stack, they're doing that typically for the lender. So you're looking for probably 15% of the capital stack to be made up of deposits. But if you see that you've got 10 million that makes up your 15%, but you're actually going to be able to collect 18, the surety will typically build the facility size for that maximum amount of usable deposits. And so that's why you'll sort of see a difference between what they've put on there, and then all of a sudden we're like, no, you can have 18 million. That's sort of the reasoning behind that. In terms of why choosing a developer surety facility, we're using that same example that we just talked about. And as I said, it comes down to the dollars and cents. The money that you save is actually going to the bottom line. So on the left here, you've got this example and that source and use of funds. So the left being your capital stack, that using deposits versus the right where you've foregone the use of deposits and you simply used an increased construction loan. And when you're looking at in terms of the revenues, obviously the revenue is not going to change, but you've got, so deposit use, it should say, is really, that's the premium cost, not the interest cost. So it would cost you $240,000 to use all of your deposits over the course of construction, whereas in the example on the right-hand side, you have zero premium because you're not using them, but you have the increased interest cost. So for the example, we used a fairly low interest cost right now, which is 5.5%. But given the 5.5% and the premium of 1%, you're actually looking at actual dollars of $1.3 million in savings over the course of a 2-year project. And so
when you say to begin a construction project, a minimum pre-sale test of 70% must be achieved, who says that? That's a carry-on requirement, or that's a bank requirement? Or?
no, that's a sovereign's requirement. Yeah, the bank will also have a minimum sales requirement, and it's usually 70%. So a lot of what we've done is piggyback. The reason for a 70% sales threshold is that, you know, all other things being equal, at 70%, everyone can be paid back. You haven't made any money yet, but everyone can be paid back. So the chance of, there is a much better chance that the project will be completed. We are in the market space getting some pushback on this. Sovereign will not release deposits prior to that 70% threshold being reached. It is part of our treaty. So, but we'll see some of the much larger, the top, when you're talking about the top 25 developers with the really deep pockets and all of that, you know, I think that is going to change a bit in the industry. But for the time being, we are a 70% sales threshold. So in terms of understanding our clients and the projects, I talked a bit about how Sovereign splits up the projects into a client underwrite and a project specific underwrite. So some of the things that we're looking at for the client portion is tenure and experience in the industry, the business and technical skills of the team that you've put together, capacity of the client, equity and security, and then just the overall financial assessment. And that's at the sort of beneficial owner. You know, if we're looking at Menkes, this is when we're looking at Menkes, not the numbered company that has been, you know, created for that project. That's what we're looking at, the overall client, the umbrella, and then we have sort of an ABC rating. For the project specific, that client rating does make up a portion of the project underwrite as well. And then we're going to be looking at the project budgets, any project specific indemnitors, any indemnitors that are sort of umbrella and overarching would be included in the client underwriting. We look at the project overview, the work in progress, and the project team. The work in progress is a bit of an onerous task when you're asking builders to do it, but the reason that we look at doing it, especially with a new client, is if we have two clients come in and they both say they're building, you know, they have a 5-project horizon, and what we want to know is, you know, are you going to try and build all 5 projects at the same time? And you're gonna, you know, you're building one in Scarborough, one in Pickering, one in London, or is this over a, you know, 7-year horizon where you're going to have one in marketing, one in construction, one starting to close, and you're going to be filtering those funds through. Obviously, the latter of those examples is the client that we're looking for. You want a client that has a healthy pipeline, but you don't want a client that has spread themselves too thin. And if you run into some kind of delay, that could really affect all of the rest of your projects. I know last summer that there was a delay, like the painters went on strike, and that was delaying projects between 6 and 8 weeks, and that's just one trade. So, and that affects everybody down the line. So the developer that you don't want is the developer that has everything happening so closely together that they're completely dependent on closing these units so that the proceeds of those can go into the building of these. And if you don't close this project on time, this project stops. So that's why the work in progress is so important to us. We do get a lot of pushback on it just from the developer, just because it is work. And then the project team, what sort of I like to tell developers, and I think I said this in our call, is, you know, we don't expect our developers to be an expert at everything, but we do expect you to hire the experts. So sort of the big 4 that we look at is the solicitor, your GC or your project manager, depending on if you're building in-house, the lender, and the cost consultant. So we have our sort of preferred lists of all of those. And I think I sent those to you, right? Yeah. Yeah, and that comes just from the level of experience that we know they have. You know, you may not think it's important to hire a solicitor that has done this a million times, but if this is your first time doing it, you want somebody on your team that knows exactly what's going to happen, because chances are that is not going to be a completely smooth process. And if both of you are learning at the same time, it could be incredibly detrimental to your project.
Cost consulting too, because you need to have the correct update and know where everything is so you can have the escrow release.
Yeah, exactly. So that's exactly it. In terms of the cost consultant, that's what starts the process of deposits being released from trust. So I am not a cost consultant, so that's how we've framed our business, that I'm not going to be looking through, you know, GLs and invoices and all of that to say, okay, you know, you spent about $2 million, like that's what we'll release. That's what we're getting from the cost consultant. In addition to that, they're going out every month and taking pictures of it, which is, it could be seen as small, but it's really not. If I'm looking at a draft margin that says the project is 65% complete and I'm seeing a hole in the ground, like it sort of raises a red flag, right? So just things like that. They monitor not only the cost, but they monitor the construction schedule. So they give us an opinion as to, because once we start the project, we have occupancy dates, estimated occupancy date, registration, and final closing. And where those tie in for us are things like when does their insurance expire? When is their repayment date for their, I mean, obviously the huge one is when is the repayment date on their construction loan? So as you start approaching those, so a cost consultant is able to tell me that's very optimistic, or they've actually asked of the client to amend it or give other dates, and then we're able to follow up with the insurance companies, with the banks, to say, I'm working on a small commercial project up in Brampton, and based on the cost consultant report that was provided, I looked and it said, you know, I was doing the draw on September 7th and their loan repayment date was listed as August 31st. So it's just things that we have, you know, so I just contacted the bank and said, hey, what's going on? And he said, no, it's fine. We have a 30-day renewal period that's okay. We're still going to be releasing, and we're able to do that. So all of that information comes from the cost consultant reports. This next slide is usually one that we spend a bit of time on. Hopefully you guys can see it. So this is sort of the cradle to grave of the Tarion experience for a developer. There are different parts to this, and sort of why we call them Tarion bonds, warranty bonds. They're all the same. It's all the same bond. So when you're looking at it, if Tarion is requiring a bond right from the outset, which means that it would be what we sort of call a marketing bond. So all that does, no funds aren't really released from trust then. The bond is there to have them gain their registration. And so when we're looking in terms of what we have is sort of the surety's exposure on the bottom there versus the life cycle of the Tarion bond. So once we submit that bond to Tarion, our exposure in year one is simply the bond. We call it a very low risk period because typically funds are not leaving the trust account, which is where even for a new builder you can see a lower premium on the marketing bond just because it is lower risk. And so once we're looking at this, if we're doing a kind of a 6-month marketing, where that's where you're just trying to build up your sales. So nothing's really happening. You're trying to get to that 70%. Once you're at the 70% and everything is a go, you're going to have, we call them go terms or something like that, where then you're going to be in construction and funds can possibly be released. So you'll see that as you are completing construction, the exposure of the surety goes up because that's when you're in the process of getting the monthly draw reports, you're making the draws, and that it increases incrementally as the money comes out of the trust.
It's a lot easier seeing it on paper than
trying to figure it out. Yeah.
Yeah.
Yeah. So the highest risk for a surety is actually between occupancy and registration. The reason is that you're collecting that last 5%, you're using it, and the condo hasn't closed yet. So for a surety, that's the highest amount of exposure. So that's where we're at the most risk. Once interim occupancy has happened, that is when the Tarion unit warranty kicks in. It's not a final close, because that could be, I mean, everybody hopes it's 3 months or 6 months. We typically look at a 6-month horizon for between interim occupancy and final close. But I mean, we've seen it 2 years. That's not a very happy situation, but it's what we've seen. And we've seen some really great builders that are able to occupy and close on the same day, which is sort of unheard of. So once you're looking at condo registration, and then you can see at final close there that lines up with the exposure of the surety decreasing pretty dramatically. And that is because that DPI, if we look at our example before, you're going from $18 million worth of exposure to 3, because there are no longer any deposits that you are protecting. And in terms of your final close, that's when the common element part of Tarion's warranty, that's when that kicks in. So the unit is at occupancy, the common element, which is $50,000 per unit up to a maximum of $2.5 million. But it's all contained within we don't have to provide an additional bond for that or anything. So, at final close, you're looking at, this bond's already been out for 3.5 years. So you're looking, it's a long horizon that you're looking at when you're looking at these condo builds. We have the field review report, which you may have heard it referred to as the B19s, or milestone reporting from Tarion. So the final B19 report is done, and then within a year you have that technical audit for the common elements. Based on the type of risk assessment letter that you've received from Tarion, typically you're not looking at your first Tarion bond reduction until 2 years after condo registration. So if you're familiar with the risk assessment letter at all, it will say if you're looking at security, it will say the greater of $20,000 a door or the risk assessment amount. And that's as you start to build history, that risk assessment amount could become lower than $20,000. So that's technically the difference between your deposit risk and your warranty risk.
So I've had clients ask me to kind of come in sort of towards the end there because they felt that the bond requirement was high and they were paying a high amount when the exposure was low.
Mm-hmm.
Do you guys see that, or what's the surety stance on that, or can you surety stance on that? Like say he wanted to get the current surety off, bring new on. So you're obviously looking at it a bit differently because the exposure is low, with the commitment of the next building or
right. So when you're looking, when you're looking at that, what you're actually looking for is the warranty retention amount of the surety. So that is the minimum amount of either deposits or inventory security that will be held. And it doesn't necessarily match dollar for dollar. Like you're talking maybe 25% for a brand new builder, you're probably talking 25 to 30% of the bond. For an experienced builder with possibly a reduced risk assessment amount from Tarion, you could be looking at something as low as 10%. Or an inventory component of that. So provided that if the warranty retention amount is $100,000, if you can have 1.67 times that in inventory value, which in this space is like 1 unit. So if you have 1 unsold unit, that could serve as the warranty retention amount. But that's what they're talking about sort of on the back end of that. What we've actually seen a little more recently is that rather than that a client having used a bond at the beginning, they've used a letter of credit.
Right.
And then now at the back end, because they've realized, okay, well, this letter of credit is now going to be out for like another potentially 5 years. That rather than put the dollar for dollar, like having to collateralize that with the bank dollar for dollar, they will ask for a warranty bond in place so that they can return the LC to the bank. So that's something that we do see. In the situation that you just described, a lot of it ends up being sort of an exercise in futility for the surety, because as soon as you brought that to your existing surety, they would just say, oh, okay, well, we'll just reduce our warranty retention amount. So, and then some of it comes from the cost of putting a bond in place.
Yeah.
And that's why we typically don't look at bonds less than $1 million, because then you're looking at all of the additional costs of putting the security in place, and it just doesn't make sense for the builder. And the same thing will come into play if you're switching sureties. So you really need to be, a client really needs to be sure that they want to do that, because all of the existing surety security would need to be discharged and all of our security would need to be put into place. And it's not to say that it doesn't happen. Where you'll actually see it happen is right at the beginning more often, when a surety has issued marketing terms with no release, and then either isn't confident in the project, or the relationship is soured, or there's been a material change in the project, and they say, we're not going to release any funds from trust. So that's where you would typically see a switch in a surety. At Sovereign, and like, I don't know, me personally, I don't like writing projects where I'm not sure that we're going to do it. If I'm not confident in the project at the marketing stage, I would just rather say no. Like we lose a little bit of premium, but it is what it is, right? Like we would rather honestly retain a relationship with a potential client versus completely ending that relationship if they aren't able to get the right team together. And we are we're very upfront about the things that we need from a client. If we're looking at a marketing bond, you're looking at it so far ahead, like so far in the horizon, that they likely don't have a lender yet. They don't, they have a solicitor, but they haven't engaged a cost consultant yet. So we do everything to say, this is who we would like you to have, but based on your lack of experience, if you aren't able to attract a Schedule I lender, we wouldn't be able to move forward. So we have confidence in the project itself. We think it's going to sell well. It's in a great area, but then it puts it back on the developer to say, if you don't put the right team together, we aren't going to be able to help you. There are other sureties that just sort of marketing bonds abound, and that's where we get the calls saying, I already had a bond out with this market, and now they're saying they're not going to release my money. So that's sort of where you see it more often than on the back end.
So just going back to the original question on the cost. So I understand that the EPI is billed quarterly, and that it follows that that nice graph you got. But on the Tarion bond, so is that 1% per year?
Mm-hmm.
Okay, and so that's what they're complaining about, that it's not on a declining balance, and because of that exposure.
It is on a declining balance at renewal. If they're
every year.
Yeah, but I mean, they're not good. You're not gonna, like, if you look at this, so you've started here, you've now had 4 renewals before anything you're gonna have anything happen with the Tarion balance. If you have a client that's in a position that the bond's been reduced, the surety shouldn't be charging on anything other than what that reduced amount is. And that's where I was saying that we start to shorten the renewal periods, because typically once we've charged it, we're not in the practice of sort of going back and rebooking it and doing all of that. So if we anticipate, okay, they're approaching their 2 years after registration, we're going to look at that. We may only bill it for 6 months. Or honestly, I would just pick up the phone and call Terry on and say, what's going on? Like, when are we looking at a reduction for this?
Okay, so you're basing it off of Terrion's requirement. So it's not, you're not the bad guy. It's Terrion who's, you're just bonding with Terrion's.
Well, we're bound to the amount that our bond is out for. So there's sort of the two components of that. Your warranty retention amount could be much less, which is dollars left in your trust account, versus the bond that's out. So regardless of what's retained, you're going to charge what the full amount of the bond that's out. So once that's reduced, if it's reduced by half, your next renewal is going to be based on a $1 million outstanding bond versus a $2 million bond.
So do you consider one of your competitive advantages your relationship with Terrion? Like if I say to a, if I get this phone call, I've had this phone call a number of times. You know, there's low risk, they've got a high requirement, I've got another project, and we explore flipping sureties. So my response to that should be speak to Terrion, see if they'll reduce your amount and stick with your current provider, but we'll look at the next project.
Yeah.
Right? If they try to call Terrion and can't get it reduced, do you feel like potentially if you made that call, it might be a different result?
It could be. I mean, I know it really well. And it absolutely is. Like, our competitive advantage is the relationships and knowledge that I have of Terrion. You know, so we've done that where we've put a warranty bond in place and the clients come back and said, you know, I really appreciate what you did on this. Right. Is there any way you can call on this other project that I know you don't have? And I mean, it's that part of it is all the client relationship. I'm not going to say, well, that's not our project, I'm not helping you. It might piss the other surety off, to be perfectly honest, that they're like, that they're going to say, okay, well, you couldn't do it, but I called Hillary and she was able to do that. Like, that's.
But in order for us to bring projects to you, not every opportunity that we see is a new build.
No, absolutely.
So Naresh or Doug or Eddie will go see a guy who's got these things up already. So what value do you add? What do I bring to the table?
Yeah, and part of that, honestly, is just simply a call, right? Like, in terms of building the relationship, that it's like, I'm always going to be willing to, you know, we have to be careful about stepping on other people's toes. But if it's like, hey, I can, you know, I know someone that can make this call. And sometimes it's simply that, is that they're saying, well, Terrion's not giving me back my money. So, okay, well, when was the last time you requested a reduction in security? And it's a blank stare and they say, well, I didn't.
Right.
Like, well, they're never going to give you your money back. Like, you'll show up on, I mean, I know for sure they have, you know, the lists that come up that say all of these are there, but that's definitely I'll get to it when I have time list, versus these are all of the new securities coming in. Like, everyone, you know, everyone there is like, they're working hard and all of that. So they're going to spend time getting the new security in versus getting the old stuff. And a lot of the time, it's given that they are the regulator, they hold a very big stick. And if you don't have, a lot of that happens, a lot of it is automated. And it could be simply a matter of you didn't provide certificates of completion and possession. So as far as Terrion understands, those units haven't closed. So when you're looking at certain things like that, or the title transfers or your B-19 reporting, chances are, if you're expecting a release of security and Terrion hasn't done it yet, it always has to do with paper. Right. They're missing something. They're missing something. that's what it is, because a builder can't, you know, a developer can't be so oblivious to say, I have no idea what's happening. And then you look at their technical audit and it's like, well, you've got $3 million worth of repairs you have to do. And if they say, well, I did that 2 years ago, well, did you tell Terrion that you did it 2 years ago? Like, well, no. Okay, we'll just make that call first. And a lot of the time, that's all it is. So on the back end stuff, that's typically what it is. And, you know, I'm always willing to help anybody, whether they're a client or not. I mean, your relationship building starts somewhere. And I'm not just going to say, well, no, they're not with us, I'm not going to help them.
No, but it's a lot of times it's a presentation. So a client who's not aware, and that's our job, is to make them aware, to give them that very counsel. If we can approach them and say, you know, let us investigate
Mhm.
what is deficient in terms of and getting that answer. And it's a really good opportunity to show that A, you know what you're doing, you've got the right partner who can make a call.
100%.
With Terrion, and like I see this really vital for you because you've got so many developer relationships. What are you going to do? Go in there and say, hey guys, give me the business and then that trial or whatever when you're not adding any value. There's got to be some value creation.
Yeah, absolutely.
For someone to be willing to give you an opportunity, right?
Yeah.
And, this is the one that I see. I don't know another one, to be honest with you.
So here's the leverage, you're the wedge.
Yeah, exactly.
But it's about, and so going back to, so there is probably a better presentation to Terrion in terms of reducing the capital requirement than just, I don't want to pay this, right? So.
Yeah, that's exactly what it is. And it's a matter of finding that out and where, I can't always call it like it's privileged information. Like I can't just call and say it. I mean, there's certain things I can do. And I mean, and that's also just the surety relationship that it's, if they have our bond in hand, they know we're dealing with them. But in that respect, where I can come in is connecting you with the right people or finding out, on a higher level that they would be able to say, well, they haven't submitted these things, or it's potentially this, or, they're.
It's how you make the presentation.
Yeah. Yeah. But of course, if that's something that ever comes up, just give me a call.
Or even just like the list of your preferred escrow agent, your cost consultants. I mean, you can help them actually build the team that they need to put together in order to get.
Yeah, absolutely. And I mean, that's not to say if it's it's a preferred list. It's not, it's not hard. Yeah. I mean, there's reasons that if you look at the cost consultants, there's reasons that some other cost consultants aren't on that, but it's not necessarily a hard no. It's not, you have to have the people on all of our preferred lists. If you have a Schedule A bank and, somebody that we've deemed maybe an average or below average cost consultant, it's just something for us internally that we know we need to keep an eye on. But if we see that you've tried to cut corners on every aspect of your team, it's a problem.
Who's the one that was it the National Bank they were using? The one my client was.
Yeah, I think she was talking about National.
Yeah.
And we would lean toward, and I think in the conversation, we have great relationships with Laurentian. We work with them all the time, even especially out there. That's with Bob and Rob out at Laurentian. We work with them all the time. We don't have a relationship with Laurentian. It's not that we're not willing to explore that relationship, but you know what you know. You know what you're comfortable with.
So this is only in Ontario. What do they do in the other provinces?
Quebec has. They have a warranty program. I'm not too familiar with it. They kind of they always tend to do their own. Yeah, they tend to do their own thing. That is one of our, I guess what we would call one of the program. It's Octave Assurance that does it. So as soon as anyone asks about it, we just direct them to Octave. And then we're obviously looking to expand out into British Columbia. They have an established warranty program there, but it's actually run by the individual insurance companies. So what we would be starting with out there when the time came would be simply doing DPI. So here your one surety is doing both sides of it, is going to do the Terrion side of it and the DPI side of it. But we don't have the technical backing, like the technical backshop to be able to do sort of Terrion's part of it in BC.
And was there any change up with the requirements when there was that bit of a Terrion shakeup?
Not yet. I think given the change in the provincial leadership, that everything's sort of on hold right now because it was sort of coming in like a freight train. And I think that was the Liberal government sort of trying to get everything in under the wire. But as you know, with the changing government, all bills and everything sort of stop. until such time as they have the chance to review them. Personally, like, this is purely conjecture, and having worked there, a conservative government likely is a more favorable government toward business, toward builders, towards things like that. And I mean, the warranty, Ontario New Home Warranty Protection Act is a consumer protection act. So what they're really trying to do is separate the licensing and registration portion of it and the warranty part of it, like the claims part of it, because they're saying you can't make the rules and enforce the rules and decide who gets to build. And so I know the way I see it, the Tarion has done an excellent job. There's sort of the old adage, if everyone walks away from the table a little bit unhappy, that you've done your job properly. So I mean, if you talk to a builder, they say Tarion doesn't care about the builders, they only care about the homeowners. And if you talk to a homeowner, they say Tarion doesn't care about us, they only care about the builders. They're in the builder's pocket, it's for the builders and all that. I mean, it's a not-for-profit agency, so they're not doing it to make money. Their sole income is builder registration fees and unit enrollment fees. So I do anticipate there being a change. Right now, unfortunately, the only change has been that they are not hiring more people. So I know the licensing and underwriting department in the last couple of years has had a series of losses. When I left, I had been there 8 years and was probably still one of the most junior people in terms of seniority in the licensing and underwriting department. Like, nobody left. Since I left, Connie Vasallo was the head of security, and she'd been there for 40 years. She'd been there since like Tarion's inception. And so she retired. One of the senior security analysts retired, and the head of sort of the condo construction actually took an industry job. So he's left. So they've had quite a shakeup in terms of that, but it hasn't actually been decided what's going to happen. I think by and large, Tarion will operate as they always have. It's just there's going to be this sort of oversight, and there will be two separate entities. But within Tarion, there is that Chinese wall. There is that sort of separation where I was there 8 years and never dealt with a homeowner. So I don't have a homeowner in my ear saying this builder is terrible or whatever it is. If anything, I was on the builder side and understand that it's their business, but you do see from a homeowner side that this is the biggest purchase they're ever going to make. But for a builder, it's one of 20 houses that he's building. So it's a very different sort of relationship that they have.
Cool.
Yeah.
Ruth, forgive me, I have a 12:30.
Oh, no
I
problem.
have to go.
So this is just in terms of the product risks. This is just more Tarion stuff, what you're actually covering with the bonds that would be provided. So $20,000 per unit in the course of construction deposit coverage, $75 per unit in delayed closing costs, which is just as it sounds. Your unit closes, but it didn't close when it was supposed to. The warranty coverages, you have your 1 year, which is what you would just refer to as your cosmetics, your 2 year covering water penetration and any mechanical issues, and the 7 year, which is your major structural defects. Individual unit warranty coverage is $300,000 per unit, and the common element coverage is $50,000 $50,000 per unit to a maximum of $2.5 million. And there's other additional coverages for health and safety and septic. And then, so that's everything that the Tarion bond sort of covers. And then the deposit is deposit repayment only, which we've kind of gone over a few times. In terms of how we mitigate the risks for the surety ourselves, we've talked about sort of the client and project underwrites that we've developed measurable analytics for that. So that's how at the end of the underwrite, it kind of kicks out one of those an A, B, or C rating. And then we have different rates and release ratios and warranty retention amounts and warranty retention composition at each one of those different ratings. In terms of the security, if you're coming from the surety world, developer surety and these bonds, deposit protection insurance, is an incredibly well secured project. We do take indemnities of the project indemnitors, but in addition to that, we get a second collateral mortgage on the project land that is only behind the construction lender. So if you have equity lenders in a project, they will be completely expected to postpone to the surety's charge. It is a collateral mortgage, so it will be on for the full amount of the facility. Sometimes that can be, especially for a first-time developer, that may be difficult for them to understand, maybe something that you do need to walk them through. If we have an $18 million charge on a project, it doesn't mean that we automatically get $18 million if only $2 million has been released from trust. That's something that sometimes gets a little, it can be a shocking number when you're looking at, oh, well, you're taking a $25 million mortgage. Okay, but that's only if we're only entitled to that if you use $20 million or $25 million. And then we take a PPSA registered priority over the deposit trust account, and we are first priority on that, meaning that essentially the deposit trust account belongs to us. We control the funds. An escrow agent cannot release funds, cannot release deposits out of that account without our direction because of that PPSA registration. And then in addition to that, we do regular project monitoring. The majority of that is done through the cost consultant or quantity surveyor reports. We depend on them. When you're in the process of construction and you're doing monthly draws, you're looking at one a month. But we do require them at quarterly once you've either stopped using your construction lending reports, because that becomes the case is that typically in the case where the construction lender is funding, those reports are addressed to the construction lender. We are copied on them, but we are in the project much longer than the construction lender is. So once the construction lender has been repaid, obviously they're not going to require any more of those reports. They then would be addressed specifically to us for us to be able to follow in on how the project is doing. And then we are trying to do project visits, and then we do an annual client review of that client underwrite, so that we maintain that, we keep it up to date, so that when the project comes in, it's still up to date and we're still able to just sort of get the underwrites done in a timely fashion. In terms of where the broker fits into all of this process is market research. So you guys are you're the boots on the ground. You have the clients, you know what projects are being built in the area. You have existing relationships with the contractors or the developers. You guys are the ones that are pursuing the leads. In terms of information collection, you're going to be educating your clients on what developer surety is, any of the questions that they have. You guys would be answering them. You're going to be coordinating any of the information that you need to make that initial submission to the surety or to Sovereign, and then coordinating invoice delivery and payment. So that would fall under your role. And then simply the relationship management. You're going to act in the beginning, you're the go-between. You guys are going to help us figure out everything we need to know about the project, any information that we have, and contacting Sovereigns with any issues that if it's service issues that the client's having. And just engaging Sovereign as early and as often as you need to. From what I understand of the contract surety, it's a very different process. This is up to a 7-year process. It doesn't mean that you need to be engaged in the process for 7 years. It's as much touch as you want to have. Sovereign will always copy you on any draw requests that you receive. It's a bit of a changing market, because I'm sure if you guys are aware or aren't aware that developer surety is the one area of sort of insurance and surety that we can go direct to a client. So we still have those direct relationships. The broker network is definitely expanded in the last couple of years, really. So while other markets don't look favorably on the broker network, Sovereign absolutely does. I mean, we're trying to build a brand, we're trying to build a business, and the more people that we have out there that know about us, and it's great for us. So we are incredibly happy to have the broker network out there.
What's the size of the market? What's the premium in developer surety on an annual basis?
I do not know the answer to that.
I'd love to know from the last sort of 10 years.
Yeah, absolutely. I can get that for you. So in terms of key information that we would be expecting you guys to ask a client for.
Is that in your app?
Yes.
All of this?
Yeah. This part of it, yeah.
Yeah.
So it'll be the app. It's the two.
Start ready.
Yeah.
It is. So it'll say additional documents required are there.
Graphic mind.
One of them, so obviously the Tarion bond application form that we've provided. The risk assessment letter is very important because we need to know the amount. It's kind of a catch-22 sometimes with this because you need to get the surety involved just at the right time so that it's not too early that you don't have enough information, but it's not too late where a 2-month process is going to delay their sales and marketing. My advice would be collect as much as you can, send it to the surety or send it to us. We can say, either we absolutely don't have enough information to move forward yet, but these are the things you're missing. We can give a discussion paper if we say, this looks like a really great project. We would like to be involved in it. Here's what we're thinking here's what we're thinking in terms of rates or release ratios. This is what we're thinking, but we're going to need these 3 documents before we can do that. And then ultimately what we want to get to is the term and condition, because that's what's going to allow us to, that's the deal. So the risk assessment letter is the key component to that, but we can always start the underwriting process prior to that because also, all variables being equal, it's going to be $20,000 a door. What we're looking for that is in certain situations, it could be different. If it's a high value, like a very luxury product, we have seen the requirement be, $30,000 prior to that. If the risk assessment amount is lower than that, it signals to us that they have a great history with Tarion. If they're given a DTA option right at the outset and they don't require that marketing bond at all, it means that we're not getting involved until they're actually ready to go to construction and having funds released from trust. Any of the work in progress, and we talked about why that's sort of important to us, and also just in terms of what they've done. List of project guarantors and the financial statements associated with those project guarantors, the resume or CV of any of the developer working on the project or their team, project lenders and consultants. We've talked about that. For us, that's one of the most important things, to know who's on your team.
Do you care who the guarantors are? So say you said the other Nikes, they've set up a separate holdco for this particular project, 1, 2, 3, 4, 5 Ontario Limited. They've shown you those statements. They're garbage, but their parent company's got great statements.
We would ask for the parent company then.
You look at them.
Yeah.
Good. You take them as a cross guarantor. But it has to be a related guarantor, not an unrelated, or do you care?
It doesn't really matter. We want people that have skin in the game. Yeah. There's got to be something there that it's like, oh, well, this person is like an equity partner. And so they're going to put this indemnity up. And one of the things we require, we don't have it on this list because we don't need it to start an underwrite, is that we'd be looking for a beneficial owner's chart so that we can understand what that story is when this sort of like window company comes in as which has happened, that comes in as a guarantor on a development project. So that's what we're sort of looking for. We will piggyback off of what the bank asks for. So we're not going to go crazy and ask for tons of guarantors than the banks ask for. There have been a couple of instances where it could just be a different kind of indemnity, whereas if the bank has asked for a limited indemnity, we still likely will be asking for an unlimited indemnity. And that's just simply because the dollar value is different. Like there's no point in us only indemnifying 50% of a $5 million facility. We're going to indemnify the full. We're going to have an a joint several and unlimited indemnity.
So again, the bond is issued for it's an annual renewable, or is it?
Yeah.
So it's not, okay. So Terry's okay with that, obviously. An annual renewable bond.
Yeah. Well, because as part of the language, it's automatically, they just get it and they keep it. So if they don't physically return it to us.
Right, okay, so,
Yeah.
So what I'm saying is that the bond is issued for the full project amount for the full, so the bond piggybacks the project same as contract surety. Okay, that's important. So it's a little different than an annual renewable because
okay.
So, but it's out there, you can't take it back.
We cannot take it back,
Right.
no. We just.
And then the other question I had was, I just slipped my mind. I'll come back to it.
Okay.
When we're done, we talk a bit about your project. You still get a little hands-on. Because I submitted one last week and fit the criteria, so I got.
It was a nice though.
It was.
In terms of the benefits of working specifically with Sovereign, I was talking about Surety broader. We've made it as easy as possible to apply for Terrion. We've tried to take a lot of the guesswork out of what you need. Our rates are very competitive. We do have early release options for developers if they are the right developer. Not everyone is going to have access to funds, and when we say early release of deposits, we mean ahead of the construction lender. It doesn't mean the 70%, like that's still hard and fast, but there is an option to have deposits released ahead of the construction lender. And for you, using Terrion bonds can save time and money. The other option is an LC. Terrion doesn't take cash over $100,000 anymore, so you don't have to cash collateralize dollar for dollar is what the benefit to using a bond would be. So even if it is $100,000 bond, a client would want to use it, but it just for us doesn't make sense. Benefits in terms of the brokerage is having knowledgeable staff willing to share information and help educate you or your clients. We're always happy to be part of a meeting ahead of time or when you want to bring the client in. We do have a lot of key relationships. While I've only been on the industry side a couple of years, I've been with Terrion. Steve has 12 plus years in the industry, and you see the same people, you see the same lenders. We know who we're comfortable with and have. If you're in a position like your project where it is really far ahead, we're more than happy to make introductions to lenders, solicitors, anyone like that, because they're really important. That team is very, very important. We pay industry leading commissions. Currently our commission structure is 20% of all fees and premium. And in terms of why we want to work with you guys is just the little acronym of CARE, which is you're going to communicate, we want to communicate, you're going to advocate to the client, you are going to maintain the relationship, and you're going to be able to educate the client as well. So that is the end of our presentation. And so anything you guys have, I'm happy to answer any more questions you have.
So timing. So once a submission is in, you've given me that list and you've approved it, and we like to collect that money up front. We give you the binding instructions, quote unquote. How long does it take you to produce the actual bond?
The process itself is a bit different. Like from what I understand from contract surety, that happens very quickly. There is probably, from the time that we get it in, we sort of have our own 72-hour rule. Like you will hear from us. We always try to complete the underwrite in that amount of time, and then at least either get back to you and say what it is that we need or or decline or whatever that may be. But once we receive a signed T&C, that's what actually gets the ball rolling. We receive that, and then we send out a solicitor's instruction package and digital security package. And that package typically contains about 20 documents, and it's our instruction to all of the security that needs to be registered. Now, that can be, the fastest I've seen it done has been 3 weeks. The longest is an infinite amount of time. I mean, we have a very large developer, a very well-known developer that signed their T&C on April 18th, and I released the bond last Thursday. And so that's where you can really get stuck in the mud. Yeah, that's where you can really get stuck in the mud, and a lot of that has to do with things like priority agreements. And that's where your knowledge of the product comes in. If you know that there's equity lenders, you know that there's conversations that are going to need to be had because they are going to have to postpone to us. There's things like I have a client that decided they really wanted everything in a rush, and we were trying to do that. We were trying to get everything in place as quickly as possible with the escrow agent, and then I got a call from the escrow agent saying, I thought this was a rush. We just got a call from the client saying their accountant told them to create a limited partnership, and now the declarant and the vendor are going to be different. I said, okay. That obviously is going to add time to it. So we called, and that's an instance where this is a broker-driven relationship, and we called the broker and said, okay, well, you guys need to, do they want this limited partnership, or do they want it done quickly? Because both of those things can't happen. And that was just an outside force. It was tax implications, and their accountant said, look, if you did this, you could do this. I suspect that it'll be,
Just nice
so
to
just
know
continue.
that
Yeah.
fastest, right? 'Cause
So
I get that question,
the
and it's like,
absolute fastest I would
absolutely.
say is
3 to 4 weeks,
I would say a month. Yeah. And it depends on the,
6 weeks.
it depends.
You
Well,
get it in 5 year.
Really below the wall.
yeah.
You have to be competitive in terms of timing. Like, you
Yeah.
can't tell. You got to give.
A lot of that, honestly,
Put it back on the client. You don't tell them a worse answer. I mean, it's nice. That's nice, but they might go somewhere else. Like,
well, and that's,
you got to balance it.
a lot of that is on the client, to be honest. It's not,
The 5, it's like now.
I say the very fastest. I say is the fastest. It's 3 to 4 weeks. Now it depends on you. Now,
yes, and that's exactly what it is.
All hands on deck. But,
Yeah. It's very important to say that it's absolutely in their control, because things have to be signed. Things have to be executed. The developer surety.
You cannot leave it to the last second because you've got a whole list of things that.
Yeah, developer surety is still a market that requires paper. Like, the bond is an original bond. There's joint authorization agreement, so it's like the physical ability to be able to come in and sign off on these documents is important. So we require our opinions and all of that. Typically, it's not sovereign that's holding the process up. What I've seen, usually what happens is if there is internal corporate counsel, they tend to hold things up, because obviously they're going to insist on seeing everything. So rather than what we do is we will engage, unless there is a major reason for not doing it, we will engage the same solicitor that the developer has. And that's simply, it's a time saving, it's a cost savings to the developer, because they're paying all of the billing. So we will engage. If for some reason we have chosen not to engage, the client will know exactly why we've made that choice. And we've only done it a couple of times. There's one project that we're working with, and it was just the lender, the solicitor just didn't have experience. They didn't have enough experience. And so what we said was, well, we're going to, if Tarion approves you as an escrow agent, you can be the escrow agent, but our solicitor,
Keep an eye on it.
yeah, so we engaged Robson Carpenter to act as our solicitor, and they were happy to sort of work with this.
Educate
Yeah.
this.
Yeah, educate the younger lawyer. Tarion, their standard for who can act as an escrow agent, they do have them, but they're not super high. Realistically, it can't be a single practitioner, and they do have to have some development experience. But they're not trying to create barriers to entry. They're trying to protect. If you have someone with no experience and they're a single practitioner, it is much easier for them to either be strong-armed by a developer into releasing funds from deposits. And I don't know if you recall a few years ago that actually happened, and the solicitor is currently serving time. So that's sort of the biggest reason. That's the biggest reason for it. So you tend to see the same names sort of come up over and over again, and
They all do one pop in, I guess.
yeah, and because it's one of those things where you've either got people doing it, they've been doing it for 35 years, and then you have this massive gap, and then you've got people that have been doing it, 5 or 6. So I know a lot of the old guard is trying to build up that knowledge and all of that, but that's why you sort of see the same few names over and over again.
Do you deal direct with some lawyers as well? Or does the industry deal direct with some lawyers as well? Like, when a developer's lawyer contact a surety to put together the bond and just deal directly with them?
Yeah, sometimes we've gotten referrals. You can get referrals. We've gotten referrals from a cost consultant. We've gotten referrals from because everybody gets involved in the process at different stages. If a developer was given a DTA, they don't need to engage a surety until they're going to, if they were given a DTA option by Tarion, they don't need to engage a surety until much later in the process, where they already have they're starting to engage their lender, they have their pro forma budgets completed. And so much like we have our preferred list, any solicitor or lender or cost consultant would have their preferred list. Like it's a pretty small industry, like it's a very niche market, and we all kind of know each other.
So what's your project?
There's a couple that they're doing, they're just in the preliminary.
So there's marketing side still?
Not even.
Oh, okay.
They're
looking to engage Tarion still, I think. Yeah.
So they're still got a lot of work to go, but
There
there was a lot of questions. Yes, they are. They're working on putting together another project. There's some- So, it's a shirt. It's a shirt. So they're looking at another project now that they're looking to get engaged with Tarion on.
Okay.
There's a few. They have 2 projects, one in Waterloo, one in Hamilton, and one of them there's some issue with some of the guarantors. So they're just getting that straightened out. The other one they're looking at.
So it's at early stages, which is good.
Yeah, because we sent them over a list of the cost consultant, the escrow agents. And during our conversation, because we had a 3-way call with the applicant, and
So you're helping them.
Yeah, Hillary said, well, if you're in Kitchener-Waterloo, this is the person we usually would go towards when it comes to an escrow agent, because they're local. Hamilton is another one, and we gave them the list. They're doing the research for the package.
Yeah, well, that's where your experience comes in to help us.
Yeah, absolutely.
That relationship.
And I mean, a lot of the information that you're providing to Tarion is what we're gonna be looking for a lot of that as well. Because for Tarion, like I don't know if you've the core competencies, if you've run into those for Tarion yet. There's these 7 core competencies that are classes that you actually have to do, or you can apply for exemption based on the team that you've put together. So there's certain things like for freehold that you have to do that. And then the process of registration is very different if you're just doing condo. So for condo, you're not required to do those core competencies, but you are required to meet with the director of licensing and underwriting. And typically they'll come out to the client's project, and they're going to look at the whole team. They're going to look at the team you put together. They're going to look further into it because they have the more technical aspect of it. So they want to see your architect, your glazing guy, your B19 consultant, all of that. So that's sort of what they're going to look at. And then a lot of them.
We should jump in on one of those meetings. Like if this deal happens and there's a meeting, we should try to sit in on it.
Yeah, absolutely. Yeah.
We should all try to do that. So I've sort of noted 4 things that I was hoping we could get from you. So the copy of the presentation.
Mhm. Get down here. Don't forget.
List of the big 4. Intro email. We're gonna actually build it into our the CRM, that when it comes in, we send it out. We'll template it just similar to what you have.
Yeah.
And actually 5 things. Yeah. So the annual number.
Yeah.
Annual volume, just out of curiosity. And I wouldn't mind an introduction to Jennifer.
Sure.
Okay. Maybe her and I could have a coffee or something.
And is that for the warranty or for those programs?
I guess warranty program and InsurTech stuff. We do some
Sorry, what was SureTech? Is that what you said?
InsurTech.
Oh,
So
InsurTech.
we do some work with car dealerships for having them resell our warranties.
Okay. Yeah, just so I can say to her when I say it, and she's like, I'm totally the wrong person that you should be talking to.
I'll send you the website.
Okay, perfect. Yeah, because then at least I can figure out if I've directed you to the wrong person, who we can. Because it's funny because like I work for the insurance company, but Steve and I are such an island
Yeah, I totally get it.
because no one really, we don't do what anybody else does.
That's great. That was really informative.
It's a lot easier to kind of follow along when it's on paper.
Yeah, I thought about that, Jared.
Back and forth.
I wish I would have done this 5 years ago, because I would have closed a lot more deals.
Yeah.
Or I would have closed a deal.
Well, that's what we're kind of hearing from a lot of the newer like broker entrants is, I think it was one of you guys that actually said it to me. It might have been Doug, that he was just like, I got tired of turning away business. So if you have you have existing relationships with these clients and they've either been directed directly to us, or you're directing them to another broker, which you don't want to do.
No, we should probably retain if we can. But this is a good step towards that. Poor Hillary, it's Friday. You were working from home and you.
Oh, that's not a big deal.
Thank you for your time on that.
Yeah,
Thank
no
you for this
problem.
time too.
Yes.
I'm trying to get.
So you going back to the office or you work?
No, I'm gonna go home. I'll work from there,
That
but
can't be fun having an office down there.
sorry.
That can't be fun having to go down there all
No, it's to be honest, it's not too bad. I take the train,
the time.
and we're like
That makes sense.
we're connected to the to the ACC. Like it's a 5-minute walk from.
Well, if you take the train, it makes sense.
Yeah, it's not bad. Like I'm pretty spoiled. Like I get dropped off of the train, I get picked up from the train. Like so, I really can't complain. Yeah, I can't complain too much. Yeah, so typically if I'm driving out